Welcome to the Trailer Park Podcast, where we go full throttle on faith, freedom, and cash flow. We dive in and have the real, unfiltered conversations with industry professionals about buying deals and creating lasting passive income. What's going on, Art?
Well, just working away this afternoon, getting ready for the holidays.
I hear you told me the other day that you had to button up a bunch of more deals before you were totally done.
Yeah, that's right. We had 15 to close this month, and we've closed 8. So we got a few more to go.
Nice. Well, hey, you're almost there.
Almost there.
Well, hey, thanks for joining me on the Trailer Park Podcast, Mr. Art Tuverson.
Oh, you're welcome. I appreciate being on.
This is all new stuff for me, so it's kind of fun to try out.
Well, you look official, Blake. I mean, I got to say, you look like you've been doing it for years.
Well, we had to put it together right. You know, I had to get a different color hat for every episode, you know? So, yeah, well, I had just a few things I wanted to cover with you. And then other than that, just shoot the bull a little bit to kick it off. So the other day, we're starting to expand. We're going to go into Texas. And we're having a chat with the Suns. Is that right? Yeah. Sunstone guys.
Right.
And so he mentioned that you and he have been talking, smack back and forth several years now about surfing with you in trestles.
Yeah.
So he's going to be on, is it Casey over there? Or
no,
which
there's
one's
Casey and Waylon. Both of those guys are they're the two main sales brokers there in the Texas office of Sunstone.
And so it helped my story to name drop you, the surgeon, as our loan guy.
Well, good. I like that.
So he said he's been BSing with you for years about how you've been trying to get him out at trestles, and he refuses to go. Is that so? Which one is that? There were all three of them were on the phone call, so I was getting confused on who was talking. But is it?
Oh, you know what, Blake? I don't know if I could tell you. I extend just an invitation to guys in the industry to come out. If they ever come out to California, I'll give them some surf lessons if they want them. And some guys are like, "Yeah, I'd love that," and other guys are like, "Oh, I'd hate that." And the only person I've ever surfed with, well, there was a sales broker down in San Diego who's no longer in the industry. I surfed with him, and then one of the guys from Sunstone's friendly competitors who's a big surfer, and that's been it. So maybe they'll take me up on it.
Well, so yeah, he was saying he was scared to go to trestles because he thought he was going to get beat up by the local crew there.
Yeah, I don't think I'd take him to trestles, especially if he's a beginner.
Is that one of your spots though? Do you like to go there?
Yeah, that's where I surf. I'm located in San Clemente, California, which is South Orange County, and that's a very famous surf break for guys that surf. They come from all over the country and the world to surf there, but it's not for the beginners. There's other spots we go to get guys up for the first time that would be a little more congenial, and a little easier to handle for sure.
All right, good. So I wanted to hear your thoughts on Texas. I'm sure you've done some deals, and I wanted just to kind of get your 2 cents of how. I asked them about the taxes, and we're going to kind of schedule attorney calls and all that. But how does the underwriter view that, and how do you guys view Texas from like a property tax standpoint and the underwriting side?
Yeah, well, first off, we're bullish on Texas. Texas has the winds at its sails, so to speak, in terms of population and job growth. So they've got net in-migration, jobs are being created, left and right down there. And so we're bullish on it. There's a little bit of a joke in California that says that the best governor of the state of Texas is Gavin Newsom, because he's sending so many jobs to Texas right now. So
yes,
we're bullish on Texas. And as far as how real estate taxes are handled, we rely upon the appraisal.
Okay.
And so we will look to the appraisal to base their real estate taxes. And generally what they do is they will look to tax comps. The MHCs by and large have escaped the real big year-over-year increases in real estate taxes by a lot of the assessors other than Tarrant County. They've had some problems in Tarrant County, which is Fort Worth. But by and large, they've escaped a lot of the big tax increases. And so, we will look to the appraiser to come up with tax comps based on other properties there. And, Texas is a non-disclosure state, so we keep the loan amount out of the, the deed of mortgage.
Interesting. Okay. I wondered how they did that. All right, cool. So you just keep it off the deed.
Yes. There are a couple of wily assessors down there that have been able to get appraised values out of, public registrations for securitizations down in Texas. And so, some of the assessors down there are hip to it, but by and large, we as an industry have skated any major tax reassessments down there. But when it comes to underwriting, we will look at tax comps and based our underwriting off those tax comparables.
Got it. All right. Well, that makes sense. A lot of the stuff that I've been hearing is from the multi side, which I do think is a bigger risk because you have so much more improvements and it's going to hit radar probably a lot more than our little trailer park stuff. I feel like the industry in general kind of tends to stay out of that a little bit better. Well,
we're a much smaller pond for the assessors to fish in. If you think about the value of MHCs versus multifamily in the state of Texas, it's just two different scales. So that's one thing. And plus the MHCs don't trade as often as multifamily projects do. So there's not as many comparable sales for them to grab onto, which I think both of those reasons have caused us to fly below the radar a little bit.
Well, that makes sense. And there's really not, from a tax assessor standpoint, not a ton of meat on the bone if they spend a lot of time there. Whereas the multi guys and all the apartment deals that are trading all the time, that seems like a juicier, better time spent.
Right. Bigger pond to fish in.
Yeah.
That's exactly right.
All right. So you're wrapping up the year. It's been kind of a wild year. What was your year? I've been hearing that transactional volume, it has been overall up.
I would say that's generally the case. I didn't come prepared to give you a breakout, but
no worries.
This year was a fabulous year. We'll close over 80 loans, which, considering me and two other guys, is just a phenomenal run rate. We're really excited about that. I think that there were a number of reasons why 2020 was so good. We have a fabulous team at Berkadia. So we've just been pushing on all fronts. We're even hiring a new person. He starts mid-January. So we'll be able to run even a little faster in 2021. Certainly interest rates were low this year. And so, that helped a lot of guys kind of come out of their portfolios and refinance some deals early, which was a strategy that we were presenting to guys. And maybe we'll talk about that a little bit later, but all in all, it was a great year. Predominantly we were fixed rate and floating rate with our Fannie Mae and Freddie Mac program. Berkadia is a direct DUS and seller servicer for both of those lenders. So we were firing on floating rate loans, fixed rate loans. We also did a number of small balance loans, which are loans less than $6 million through our Fannie Mae small balance program. This was a year where guys started pulling out supplementals on deals that they bought in the last 2 or 3 years. And I expect that trend will continue in the future and to grow. Yeah, it was kind of fun. Actually, we got a couple calls this year. We closed some supplementals where we were able to advance additional loan dollars, and the interest rates on the supplemental, even though they had an adder for the fact that it was a supplemental, not a first mortgage loan, the all-in interest rate was lower than their first mortgage when they closed the deal 3 or 4 years ago.
How cool is that?
Yeah.
We're kicking around, and we'll be sending a deal over to you shortly. But yeah, we're looking at that. It looks like the rates could land about even, maybe not better. But we did a couple of deals in Tucson a handful of years ago, and it was a 4% rate. It was 2016 we bought them, and it looks like we can get roughly a 4% rate.
That's right.
Which is like
right. Which is pretty
crazy. Cool. Like, how cool is that?
Yeah.
So yeah,
it's pretty good. Yeah, we didn't hit on any life company loans this year. We generally do a handful of them, but we expect that to increase in 2021. And we did one CMBS loan. The CMBS market was shut down for most of the year
Yep.
I shouldn't say most, for about half of the year because of COVID. But we ended up closing one. And I think that's more of a testament of how much we can get done in the agency space as opposed to just a few, conduit loans coming in the door. I mean, we're by and large able to get a lot of deals done with our agency lenders, whether it's, park on home percentages up to 40%, whether it's occupancy in the low, 70s, whether it's, parks that are located 100% in the flood zone or properties that have a permanent RV component to them. So we were able to get a lot of those deals done and fit into the agency lending programs, which is a much better execution for the borrower than a conduit loan.
I couldn't agree more. And so was there a big swing of the needle where you were able to get, like you said, up to 40% park on home? Is that a Freddie deal or were they both flexible? Did it go one way versus the other on those types of challenging deals?
Yeah, generally Freddie Mac is more flexible or understanding than Fannie Mae. They're going to look at the asset, the market, the leverage, the sponsor, and the sponsor's expertise. But generally speaking, Freddie Mac is a little more compliant with higher park on home percentages than Fannie Mae is.
Oh, interesting. Well, it's funny now to see a little bit of difference and change in the tide from our perspective on Freddie being more competitive and even on the supplemental stuff too.
Yeah.
Fannie's just not as aggressive, I'd say, in general.
Well, it ebbs and flows, It really does. And a lot of it's specific to, the deal that's coming in, but it ebbs and flows, for a good chunk of the year, Fannie Mae was beating Freddie Mac on pricing. They still are, but they seem to be maybe just a little more temperamental in what they were willing to lend on. So a number of guys were going into the Freddie Mac program, either because it was floating rate, Freddie Mac wins all the floating rate business, or because Fannie just wasn't getting as sharp as they could have for different reasons. And so they ended up going Freddie Mac.
Got it.
One other loan I wanted to tell you about. We just closed it today. It's called a condo conversion loan, and it's specific to California, where a number of owners have put condo maps on their property so that they can sell the individual lots out to the residents. And this is a way of unlocking the trapped equity in MHCs that are located in rent control areas. If rents are kept artificially low, what happens is the value of that site moves into the home rather than to the dirt because the rents are artificially low. And so owners can unlock that equity or move it back to their property, which is where it should be, by selling individual lots to the residents. And so we used to do those at a previous employer back maybe 10 or so years ago, pre-Great Recession. And, we just closed one of those today. So maybe it's a sign of income in California.
And is that a deal that already has some condo owners, or is they're about to begin selling them?
They're about to begin selling them. And so the trick is you need to find a lender that not only likes MHCs, but one that will allow for individual releases. Because if you have a 100-site MHC, you're going to have 100 different parcels when you go to condominiumize it and to sell it. And so if the owner in lot 14 decides to buy their parcel, you have to release the collateral on lot 14. And so it gets to be administratively challenging. And so you need to find the right lender that can do that. So we were able to find one in California, and you close it today, and they're off to the races.
Nice. And so that they could, and that was a new purchase. So they could purchase it, do the condo mapping, and turn around and sell the individual lots.
So you could do it on a purchase. This one happened to be a refi.
Okay.
Multi-generational owner up in the Bay Area. And they decided that this was the exit strategy that they wanted for their community.
Which I think that's probably the best way to sell that deal. That's some cumbersome law, shark infested waters, if you will. Like, it's just be tough to do anything there.
Well, not only is it the best way to sell a property in California in a rent control area, but it's great for the resident too, because then they're able to buy the dirt. The initial residents, I think, will be able to get some type of small discount, and so I think everyone could win from that type of exit.
Yeah. Yeah. With rates down too on their end, on the consumer
Right.
side, that'll be a
Right.
home run potentially.
Right.
And then they control it. They turn it into a HOA. They have fun running it. They do their thing.
They
That's
do their
cool.
thing. Right.
Yeah.
Right.
I think that there's some nice beach front, type mobile home parks over the years that have been, converted like that.
Yep.
Well, all right. So how did 2020 differ in overall business? So you said you did roughly 80 deals, and I don't need, you don't have to go into details, but did you do more business this year, you think?
Oh yeah.
Yeah,
By
crazy.
far. Yeah. We were
So,
probably 2x last year.
wow, that's
Yeah.
big. That's
Yeah.
awesome.
Yeah.
Considering that there was like a solid quarter or 2 or 3 months of time where things were stalled, I think that that's pretty awesome.
Yeah, I got tenuous right at the start of COVID because no one knew what to expect. I mean, now we're learning to live with it, or at least we understand what the disease is doing. But if you remember back to like February or March, no one really knew kind of what was going to take place. There were some people saying that a couple million people could die in the United States. And so it was really an unknown, and the lenders started getting skittish. But after that, once people kind of wrap their heads around it, it's been off to the races and been a very, very busy 2020.
Yeah, I agree. And yeah, rates and everything have been amazing. We got that deal with you guys at like a 3% rate, which is just absurd. And
Phenomenal,
it really,
right?
really helps cash flow at 3% on 5 caps, like, holy
it really
hell.
helps cash flow. Yep.
Oh man. So yeah, it's awesome. So any new business changes like that you and I kind of went down the rabbit hole at that dinner a couple months ago, but it was a big change of everyone accounting shifting over their MH accounting, like park owned homes.
Mm-hmm.
And so is that kind of the new standard of tracking all of your costs associated with running your park owned homes and your operation for like the dealer entities separate? Is there anything else like that? Or is that also like the new standard that you're seeing?
It should be the new standard. I don't think that everyone else is doing that. And what we were talking about for the listeners, what we were talking about there is segregating not only the revenue for the park owned home, but also the expenses, and to make sure your expenses are properly allocated to that park owned home P&L, which would include, the real easy items to identify, right? Maybe there's real estate taxes, or there's insurance on those homes, or repairs and maintenance, turnover costs. Those would be the easy ones to allocate or to put on that P&L. But then you could also start allocating payroll, your maintenance person, your on-site management. There's probably a portion of your G&A that you can allocate pretty easily. And so then you start to really move even more of those expenses off the property P&L onto the park-owned home P&L. And you do that because the lenders will underwrite the property P&L, but not the park-owned home P&L. And so it can help you increase your loan proceeds or achieve a lower rate if you're not looking to maximize loan proceeds. So that's what we were talking about. I don't know that there's a whole lot, that's going to differ in 2021. Blake, the Fed did just come out, or not the Fed, the FHFA did just come out and update their guidance for 2021 for Fannie Mae and Freddie Mac. They did lower their lending cap. And so capital is going to be constrained in 2021 more so than it is in 2020. So the FHFA, who is the federal regulator of Fannie Mae and Freddie Mac, said, look, you guys can lend $80 billion each in 2020. And they came out and said, we're going to reduce that to $70 billion in 2021. So, it's about a 13% decline in their overall lending limit, which is going to constrain capital. Certainly, we're going to feel it. And
Is
then
that
the other
something,
thing,
is that something you should focus to get some deals on the board earlier or anything like that? Like any strategy that we could play on the buy side or selling, frankly, like anything like that would help? Is it better to get deals done in the first 6 months because you're before the cap runs out?
Yeah, well, historically, the FHFA has only made changes to the cap once a year. So they would announce it in kind of that October, November timeframe, say, hey, this is a guideline for the upcoming year, and then they would go away. They did say in this particular instance that they will be monitoring the markets and could make changes in the future. And so, that would be unprecedented because they've only done it, once a year. So what I am telling my customers, if they have a discretionary refi, or if they are looking to sell and want the buyer to be able to pay top dollar because they're able to attract a lower interest on their loan, then the first part of the year is going to be more advantageous than the second part of the year.
So they're maybe going to be a little bit better value based on their underwriting, and you're going to get maybe an all-in rate of a little bit more competitive.
That would be my expectation. Treasuries are, still very low. They're up off their lows, but they're still very low at like 93 basis points today. Could we see some movement in treasuries? Yes. But if you kind of hold all those different variables constant, the fact that there's less capital for 2021 is leading me to encourage guys to think about any voluntary activities or discretionary activities, whether it's sale or refi, to do that earlier in the year rather than later in the year.
What about supplementals? Does that same kind of story hold?
Well, that's a great point. So right now, the agencies are seeing inflows, new loan requests at 2 to 3 times their average run rate for 2021. And so they're going to moderate that level through in a couple of different ways, because the agencies need to have capital available on December 31st, 2021, just like they did on January 1st, 2021. So they can't run out of it during the year. And so because they're running faster right now than their projected capital is for 2021, they're going to moderate that a couple of different ways. One is through pricing. We've seen pricing increases and just base grid pricing by about 35 basis. It's gone up about 35 basis points since the beginning of November. So there have definitely been some pricing increases just on the grid. When you layer in the fact that the treasury is up as well, it's a little bit of a double whammy. The second way that they're going to moderate inflows is just credit exceptions. They're just going to be stingier with anything that's outside of their lending box. And the third way they're going to do it is they're going to put limits on discretionary cash out refinances. And so one might think, oh, my conduit loan, is maturing in 2023, but I'm going to take advantage of the low rates today and pull out a bunch of cash and go buy some more mobile home parks, or buy that big house up in Park City, or in Hawaii, or somewhere that they want to live. They're just going to start to put limits on the cash out refinances, and the supplemental loans would be one of those. We saw them do that during the early days of COVID.
Okay.
And would expect that if capital continues to be constrained in 2021, that they are going to put limits on supplementals, because it would just be cash out refinance for no other purpose, when their real purpose is to handle the acquisition financing.
Got it. And so it would be good potentially to submit and get everything rolling in the first quarter if you're going to do supplementals.
If you have supplemental loans, which would be just like a cash out refinance, maybe you're paying off a bank loan or a conduit loan that's coming due in the next couple of years. It would be my suggestion that you do it in the first half of the year, because you'll have less stress and concern than if you wait to the second half of the year.
Got it. Yeah, we did a couple of those value add deals that it's like, well, rates are still really good. Let's see what we can get.
Right.
And so yeah, well, and on that front, like our Arizona home sales and all of that execution has been better than we thought, because of the market movement of consumers and their willingness to be in a mobile home or a manufactured home that traditionally maybe they weren't looking for. So It kind of was a luck of the draw. Sometimes better be lucky than good on that kind of thing.
Absolutely.
So it's been good. We're just about out of inventory. We just put in another order for like 25 homes for 2021 and throughout the portfolio. So it'll be good.
Good for you guys. I love it. I love to hear that occupancy is declining, vacancies are filling, because that means you're putting new residents into new homes, and they've got to be happy. They've got to be pleased to have an opportunity at home ownership, and then it benefits you and your investors as well. So that's great.
Right. So it really has been a blessing this year with all of the movement in the market. So can't complain on this side. And so then we're just kind of regroup and start hunting for the next deals in 2021. And there's already some things shaking loose, but I will say the brokers seem to do pretty well on the transactional side. Capstone, the guys that do a lot of East Coast and like Texas stuff, they were up from 350 million in 19 to 500 million in transactional volume in 20.
Well, that's great.
And another buddy of mine, John Sheedy, I had on here the other day. He did like his best year ever, was basically what he said. He did 27 mobile home park, trailer park, or RV parks transactions in 20. So that's one guy, basically one guy.
What did he say was the reason why, did either of them say why they thought they were up from 2019? Because you keep hearing about a constraint of available properties, but both of those sales brokers are up. It's just interesting.
So a lot of the guys that historically have been holding are concerned. I'd say a significant portion are concerned about the prospect of Biden's capital gains game plan.
Okay.
So right. I'd say that and like the low rate environment, like if they were if they're in that particular time frame of considering a refinance, like the prices, cap rates took a nosedive with interest rates to where you could get a little bit bigger on the purchase price, sharpen the pencil a little bit more for the guys coming in, and so they just were able to put some big numbers together. And a bunch of guys slammed the year shut, as you're bumping into, where that people want to close in this year because of that prospect of the tax increase for 2021.
Yeah, I think that was a factor. There were, we saw a big push kind of in, August, September with refinances and sales. And I think a lot of that was people just reading the tea leaves on the election and wanting to take what they know today as far as the tax code is concerned rather than gamble. I had one customer who I was talking to acquiring a park. I said, okay, yeah, when do you want to close? And he said, well, the seller told me if Trump wins anytime in January, but if Biden wins, it's got to close by 12/31.
Oh my gosh. Yep.
It's kind of a funny anecdote.
I passed on a deal because we were having the baby and they wanted to close it at the end of the year. And I'm like, yeah, I don't want to go through that. And we're not big a boy enough to write a check or do that kind of thing and just kick it into the next year. So we got outbid, but nonetheless, it was interesting to hear the stories. And then a couple of new players stepped up and could write a check. So hey, name of the game. All right. So let's see. What are you excited about right now in business and looking on the outlook of 2021? I try to focus on the positives in this day and age and with the country where it's at. So I'm curious what you are personally or on a business side excited about going into the new year.
Oh, I think on the business side, it's been rewarding to me in 2020 to talk to my customers about looking at their portfolios to see what loans would make sense to refinance today, even though they're paying a prepayment penalty.
Right.
We saw a lot of guys do what we call a preterm refi, which means that their loans maybe mature in 1, 2, or 3 years from now. But when you analyze the cost of the prepayment penalty, the tax savings, the savings from the lower interest rate, it really makes a lot of sense to refinance today. We had a lot of success with that type of analysis in 2020. A lot of guys were saying, hey, thank you, because they were able to lock in low rates that they couldn't get today, even though rates are still very low on a historic basis. So looking forward next year to having more of those conversations, being able to help customers analyze their capital to make sure that it's super efficient. So that's going to be the focus on 2021. And then, personal wise, excited. We are planning a ski trip to Colorado in a couple of weeks. Yeah. So we're super excited about that. We had one planned to Switzerland last year, Blake, and we were super excited about that. But then COVID came, and right now Switzerland's not letting U.S. travelers in there. And I'm not expecting that's going to change. And so the trip that we were going to take March 2020, we rolled it to 2021, and that's probably going to get rolled to 2022. So we just planned a backup up in Colorado to go get some snow up in Aspen. So super excited about that. Get a little break from the kids, from the work, just from everything.
Is that, so that's a trip you're going to take with just you and your wife?
Yeah, that's right. My wife and I, and then one of her friends and her husband. So pretty
Cool.
excited.
That'll be fun. Yeah.
Yeah,
I've actually always wanted to go and ski like Zermatt in Switzerland. Is that where you were going to go?
that's where we were going. So come next year when we go in
All
2022, it'd
right.
be
Keep me in the loop
awesome.
on that. Yeah. That'd be
Okay.
fun. Yeah. I've
Yeah,
always wanted to go ski the Matterhorn and like do that whole thing. And you have to take the train ride up into the
that's it.
mountains. And yeah,
That's it. Yeah,
that'd be
it's
fun.
pretty. It was going to be pretty fun, but our fun's going to have to wait because there's more serious stuff we're dealing with right now. But once hopefully once the vaccine gets in and starts to make some inroads on this disease, we'll be able to get some break from all of the craziness that's going on, and we'll just look forward to having some fun later at a later date.
Yeah. And Colorado's beautiful too. So you can't go wrong there.
It ain't too bad. No, it ain't too bad. So,
No,
what are you looking forward to in 2021?
So, well, I'd say going through the transition of having a very young daughter who's a month old to kind of going into like the 6 month, we're going to do a little traveling. I think we're going to rent a place in Texas and somewhere in Austin. I was talking to those guys
Oh, nice.
the other day for like a month and move there and just rent something furnished, go enjoy. And I like to just go submerge myself in the culture and the feel of a place, and then drive around all of the markets, the major metros, and start to just dig some roots in. And nonetheless, just have some fun too, exploring. So and then we're going to do it when our daughter's roughly 6 months. And we're going into desert fun, like UTV razor season. So we're going to go out to the river and run
Nice.
razors and probably do more of like a Jeep thing with the car seat,
Yeah.
But
Right.
me and my buddies will get out in the razors and run around. And so, yeah, we got our place at the old trailer park at Hidden Shores, and
Nice.
our family is kind of growing and getting a few spots down there. We have a bunch of friends. I actually have a bunch of investors and clients that go there. So it's all fun.
Well, that sounds like a lot of fun.
Yeah.
It sounds like it sounds like you got a good year.
Oh yeah. And then we're just chasing deals. We're going to try to do probably like 4 deals if we can get the deal flow of cherry picking the deals we want. Do like a deal a quarter roughly.
Yeah.
And just kind of keep going down the road.
That's great. That's great.
So yeah. So I really appreciate your time tonight, and thanks for getting me in, cramming me in before the end of the year. I'm excited. I'm building up a few good episodes, and we're going to go live in January and start to put them out there and have some fun. And then we can talk some shit back and forth in the industry through this, and, hopefully get a discussion going. With no events going on, I figured, what the hell, might as well have some fun and chit chat about the industry. And it's a good excuse to get together and BS a little bit.
Awesome. Well, I look forward to it. I appreciate the opportunity, Blake, and look forward to a great 2021, man.
Likewise. And I'll keep you on the loop on all the deals we're working on, and we can go down the road.
Sounds good. Thank you.
Hey, have a good one, buddy.
All right.
Merry Christmas.
Merry Christmas to you.
All right. See ya. All right. That wraps up the Trailer Park Podcast. Hit the subscribe button for some more great industry professional conversations about buying trailer parks.